So talking about the 4 C's of mortgage underwriting today, this is super important. I often talk to people who are looking to buy a house, who need to get a loan, and they don't understand what goes into the decision when mortgage lenders are actually lending people money to buy a house. So it's good for you to know this as a real estate agent, because when you're talking to your clients and you're setting expectations for them up front, if they say, hey, I'm gonna need to borrow money, obviously when you're referring them to a loan officer, you wanna make sure you're referring someone who's even capable of starting the pre-approval process, right? The mortgage underwriting process has 4 main components. The 4 components are capacity to repay the loan, the borrower's credit, their cash reserves, and the collateral. Capacity to repay the loan in the mortgage industry is known as the ability to repay. If someone doesn't have enough income to support their current monthly liabilities and the new debt that they're taking on for buying the house, then they can't get approved for a loan. We call that your debt to income ratio. That's the technical term for it, or DTI. Again, if the borrower does not have enough income to support their monthly liabilities on their credit report, plus the new debt that they're taking on for buying the house, then they cannot get approved for the loan. And depending on the type of loan that they're qualifying for, depending on their credit score, there's a couple of other factors that we look at, but those are the main 2. It's going to determine what the maximum debt to income ratio is, which is a determining factor of whether or not they can even get the house. So you want to set expectations for your clients. You know, if someone mentions that they don't make a lot of money and maybe they have a $600 a month car payment, you maybe want to set expectations and tamper expectations on whether or not they'll even be able to qualify for the loan. You don't want to go through that process without getting your loan officer involved, but it's oftentimes a problem if you have someone who doesn't have a good income or income that we can document and they're trying to start the loan process. So when you get into self-employed borrowers, this becomes an issue. If they have a business that's making money but they don't report it to the government, that's going to be a problem, because we can't use income that they're not reporting to the IRS to help them qualify for a loan. If you have someone who has multiple part-time positions or they have a spotty job history and we can't show a history of them earning enough income to support their monthly debts that are showing up on their credit report, plus the new debt that they're taking on for the loan, they're going to have some issues. The second C is what most people immediately assume is the most important, but it's actually the second most important behind capacity, is your credit score. The credit score matters because that determines what interest rate someone would qualify for when they're buying a house. It may even determine whether or not they can qualify for a specific type of loan program, or whether or not that loan program is going to be cost effective. In other videos, I've talked to people about credit score's importance when you're getting a conventional loan versus an FHA loan. It's super important because people who have stronger credit scores can qualify for conventional loan programs that are much more flexible when it comes to student loan debt. Even when you talk about doing a low down payment on a conventional loan and you're getting mortgage insurance, your mortgage insurance rate's going to be lower if you have a stronger credit score, as well as, you know, what type of property you're buying, how much money you're putting down, what your overall debt to income ratio is will also be a factor when it comes to qualifying for mortgage insurance. But these are all the costs associated with borrowing money, right, to buy a house. So you have your credit is super duper important, but then in addition, you have to look at how much cash do you have, right? In addition to that, how much cash do I have available? If I don't have enough cash to support my down payment plus my closing costs, I've either got to get seller assist so that I can cover the cash needed at closing, or I have to get some sort of down payment assistance. Again, when you're a buyer in a seller's market who doesn't have all of your down payment and closing cost money, not having all of the cash is going to put you at a disadvantage. So when you're preparing offers for a buyer, you want to make sure they're in as strong as possible a position to be able to cover the down payment and closing costs. Because if they're not, that means that they're now going to be at a disadvantage when you're putting in an offer against other buyers who maybe have all of their cash that they need for their down payment and closing costs. So again, we've got your capacity, your ability to repay. We've got the credit. The borrower's credit is obviously super important because that's going to determine their interest rate as well as other costs associated with getting the loan, and the cash reserves that they have available. Now, cash reserves could be coming from them personally or coming from friends or family, but generally we want to see that money in the bank seasoned for 2 months, meaning it's been in the bank account for at least 2 months before they start the loan process. Then my company or any other lender that they're working with, we're not going to ask any questions really about where that money came from because it's seasoned funds. If you have recent large deposits or money that's coming into the account as we're starting the loan process, we have to source all of that money. That needs to be explained where that's coming from, and we have to make sure that it's an allowable source for the funds. Now, of course, the fourth C, I wouldn't say it's the least important because this obviously matters if someone's getting a loan, but we're looking at the collateral. So the actual property that they're purchasing, we want to verify that the property is in good condition and that it is worth what they're buying the property for, because mortgage companies don't make loans based on the purchase price unless the appraisal value supports it. So it's super important that when you're putting in offers as a real estate agent, when you're working with buyers, that you're also running comps to confirm that the sales price is supported by sold comps in the area. So again, when you're putting in an offer for a home buyer, you want to make sure that the sales price is supported by recent sales in the area of similar properties. If it's not, you're going to have a potential issue when the appraisal value comes back lower than you were expecting, and now your buyer's got to come up with a difference between what the property's under contract for and what the appraisal says, or frankly, a backup buyer may be now be coming in and getting that property because your client doesn't have the cash needed to close, or they're not comfortable bringing that difference to settlement. Again, 4 C's, we're looking at the capacity to repay, we're looking at the borrower's credit, we're looking at the borrower's cash that they have available, and we're looking at the collateral itself, the property that they're purchasing. So you want to go over these concepts with your clients up front. You don't have to obviously get into a super detailed explanation about what these things are. That's what your loan professional is for. But you want to have an idea of how these things work and be able to explain this intelligently to someone. So that way, if they do contact the lender and they don't get the news that they were expecting to hear, maybe you can kind of interpret that for them. Because I have had situations where someone was told no by another mortgage professional. They came to me and no one ever even explained to them why they weren't qualified for the loan. The real estate agent couldn't explain it. The mortgage professional that they talked to couldn't explain it. And so now they're just feeling lost. And it may be an easy fix. It may be something that they can go back to the drawing board, save up for a few months and get the cash together, go back to the drawing board, work on their credit for a few months and get their credit report so that it's mortgage ready. It could also be a situation where, they've got to look at their income. I've had people who were self-employed who were capable of getting a job and they just didn't show enough income on their tax returns from their self-employment income to qualify for a loan. So for purposes of qualifying for the loan, they maybe took a W-2 position so they could qualify for the house that they wanted. And then after they got their house, they could figure out what their next move is, but now they're able to show that they qualified for that loan because they had enough income to support it, as opposed to maybe they were running their own business or putting in less hours at a W-2 position that they held so that they could work on a business of their own, but it wasn't enough income to support them being able to qualify for the loan, even if they did in fact have the money coming in. So these are concepts that you want to be familiar with as a real estate professional because it obviously affects how you get paid. If you're working with buyers and they need to get financing, they don't have all the cash to buy the house themselves, you need to be able to explain to them why and how the loan process works and how lenders make decisions so that they can understand it when they're starting the pre-approval process and have an intelligent conversation with a local mortgage professional.